You stand at a junction where economic theory meets geopolitical force. Saturday morning, January 3rd, 2026. More than 150 U.S. military aircraft launch coordinated strikes across northern Venezuela. By dawn, President Nicolás Maduro is in custody, bound for New York. Markets barely flinch, oil dips, stocks hold. But beneath the surface, something fundamental just shifted. This wasn't about one man. It was about 80%. That's how much GDP Venezuela erased between 2013 and 2025. Not through war, through choices. The largest peacetime economic collapse in modern history happened because a system designed for abundance couldn't survive scarcity. The plumbing failed long before the price, and the danger wasn't in the strike itself. It was in what made the strike possible. If this kind of financial history sharpens how you see risk, like quietly tells the system this work matters. Picture Venezuela on Friday, January 2nd, 2026. A zombie economy, not dead, not alive. Oil production crawling toward 900,000 barrels per day. Hyperinflation finally cooling to 59% after peaking at 130,000% in 2018. 82% of the population living in poverty. 8 million citizens gone, fled to neighboring nations. The world's largest proven oil reserves, 303 billion barrels. More than Saudi Arabia, more than Russia. Yet unable to extract wealth from the ground beneath its feet. At the time, this looked like chronic dysfunction. What no one questioned was whether chronic dysfunction creates vulnerability. The story begins in 1914. Venezuela strikes oil at Lake Maracaibo. By 1929, the nation pumps 137 million barrels annually, second only to the United States. Standard Oil, Royal Dutch Shell, Gulf Oil poor in capital. The relationship appears symbiotic, secure supply for industrial powers, revenue for a developing nation. In 1943, Venezuela's hydrocarbons law demands a 50-50 profit split. Foreign companies accept. Government coffers multiply sixfold in 5 years. Democracy arrives in 1958 with the Punto Fijo Pact, stabilizing politics through oil-funded social spending. OPEC forms in 1960, giving Venezuela leverage. The 1973 oil embargo quadruples prices overnight. Venezuela collects $10 billion in windfalls. Per capita, income soars to the highest in Latin America. In 1976, the government nationalizes oil assets, creating PDVSA. By the late 1990s, production peaks at 3.2 million barrels daily. U.S. refineries in Texas and Louisiana adapt specifically to process Venezuela's heavy crude. This wasn't recklessness. Policymakers believed they were building sustainable prosperity. Agricultural output held steady through the 1950s. Manufacturing employed significant portions of the workforce. The assumption was implicit but absolute. Oil prices would remain high enough to fund diversification. But something else happened quietly. Dutch disease. The bolívar strengthened. Imports flooded in cheaper than domestic production. Farms withered, factories closed. By the 1980s, 90% of export revenue came from oil. Every other sector had atrophied. It worked, but only under conditions that would not last. The boom years cemented dependency. High oil prices masked structural decay. Between 1973 and 1982, Venezuela borrowed heavily from international markets, confident that oil revenue would service debt. The Macroeconomic Stabilization Fund, meant to save windfall profits for lean years, held less than $3 million when the crisis began. Hugo Chavez wins the presidency in 1998, promising Bolivarian revolution. He redirects oil revenues into social missions, free health care, subsidized food, literacy programs. Poverty drops 20 percentage points. Housing programs deliver homes to hundreds of thousands. But each success tightened the knot. PDVSA, once a technocratic powerhouse, undergoes political purges. In 2002, workers strike against Chavez's policies. He fires 18,000 employees, 40% of the workforce. Technical expertise evaporates overnight. Production dips, but recovers temporarily on global demand. Between 1999 and 2013, the Venezuelan government expropriates over 100 private companies. Price controls freeze goods below production cost. Currency controls, implemented in 2003 to prevent capital flight, create a dual exchange rate system. An official rate and a black market rate. The gap widens. China lends $60 billion through loan for oil agreements. The Tinaco-Anaco Railway Project, a $7.5 billion high-speed rail contract with China Railway Group, becomes emblematic. Construction stalls, corruption siphons funds, unintended consequence, complete reliance on oil revenue, deferred risk, fiscal deficits approaching 15% of GDP, temporary stability, social programs maintained through monetary expansion. The Central Bank of Venezuela loses autonomy. It becomes a printing press for the Ministry of Finance. Inflation begins accelerating in 2012. The stronger the system became, the harder it was to stop. In late 2014, global oil prices collapse. Brent crude falls from over $100 per barrel to below $30 by early 2016. Venezuela faces a binary choice: fiscal austerity or monetary expansion. It chooses expansion. The government prints money to plug budget gaps. In November 2016, monthly inflation exceeds 50%, the technical definition of hyperinflation. By 2018, annual inflation hits 130-60% according to official figures. The IMF estimates higher. The currency redenominates, once in 2008, again in 2018, and again in 2021. 14 zeros stripped in 13 years. Citizens wake up to discover their savings erased overnight, repeatedly. Food shortages emerge, supermarkets ration basics, hospitals run out of supplies, child mortality spikes. By 2017, the average Venezuelan loses 11 kilograms in weight, a phenomenon critics call the Maduro diet. Early warning signs accumulate but are inconvenient to acknowledge. U.S. sanctions begin modestly in 2006 under Bush, targeting officials for human rights abuses. Obama expands them in 2015. Trump escalates dramatically in 2019, imposing an oil embargo and freezing PDVSA assets. Venezuela's production plummets from 2.4 million barrels per day in 2015 to under 800,000 by 2020. Pay attention to this part. GDP collapses by 80% between 2013 and 2025. This exceeds the United States' Great Depression contraction of 29%. It surpasses the Soviet Union's collapse. It is the single largest peacetime economic contraction in modern recorded history, yet nothing truly collapsed in one dramatic moment, and that was the problem. July 28, 2024. Venezuela holds presidential elections. The National Electoral Council declares Maduro the winner. Independent observers cry fraud. Opposition leader Maria Corina Machado presents tally sheets showing Edmundo Gonzalez won by a landslide. The United States recognizes Gonzalez as president-elect. Maduro consolidates power. Regional and local elections in 2025 deepen his control, but the economy continues eroding. In May 2025, the Trump administration revokes General License 44 and cancels License 41A, withdrawing permission for Chevron and other companies to operate in Venezuela. Oil output, which had climbed slightly to 982,000 barrels per day by late 2024, stagnates. Trump designates Venezuelan gangs, Tren de Aragua and Cartel of the Suns, as terrorist organizations. The administration begins seizing oil tankers in the Caribbean and Eastern Pacific, claiming they traffic narcotics. Over 24 vessels are struck with missiles in December 2025. From the administration's perspective, this is logical. Venezuela ships an estimated 250 tons of cocaine annually. Drug trafficking enriches the political and military elite. The country has become, in U.S. legal terms, a narco-state. Maduro faces a 2020 federal indictment in the Southern District of New York for narco-terrorism. On January 3, 2026, at 2:01 a.m. local time, Operation Absolute Resolve begins. U.S. forces conduct airstrikes across Miranda, Aragua, and La Guaira states. Military installations burn. Delta Force helicopters land at Maduro's compound. By 4:29 a.m., Maduro and his wife Celia Flores are aboard a U.S. aircraft carrier. By afternoon, they land at Stewart Air National Guard Base in New York. Venezuelan officials report over 80 deaths, including 32 Cuban military advisors. U.S. forces suffer injuries but no fatalities. Trump posts a photograph. Maduro blindfolded, wearing a gray tracksuit. This was reasonable from one frame. Venezuela's collapse destabilized an entire region. Migration, drug trafficking, and humanitarian crisis spilled across borders. The disputed election lacked legitimacy in Western eyes. It was necessary from another frame. Venezuela's oil infrastructure decayed for years. Global supply exceeded demand. The operation would not meaningfully disrupt markets. From this point on, the outcome was no longer optional. Markets open Monday, January 5th, 2026. Oil prices fall. U.S. benchmark crude trades down to $57.09 per barrel. Brent crude settles at $60.58. Analysts note the muted response. Venezuela produces only 1 million barrels daily, less than 1% of global output. The market is already oversupplied. Gold surges 2.4%. Silver jumps 6%. Safe haven demand rises. Stock futures hold steady. The S&P 500 inches up 0.1%. The Nasdaq climbs 0.3%. Asian markets rally. Japan's Nikkei 225 jumps 3% to a record $51.0853. South Korea's Kospi hits highs not seen since 1999. Who benefits structurally? Chevron, ExxonMobil, ConocoPhillips gain potential access to the Orinoco Belt's untapped reserves. Trump announces U.S. oil companies will invest billions to rebuild infrastructure. Energy security strengthens for the United States and Western allies. Venezuelan exiles celebrate. 8 million who fled see possibility of return. Who absorbs the cost? Venezuelan civilians. Airstrikes hit residential areas in Cachilamar, killing civilians. Uncertainty paralyzes daily life. Caracas remains quiet on Sunday. Stores closed, streets empty. Regional allies condemn the operation. Mexico's President Claudia Sheinbaum strongly rejects the military action. Colombia's Gustavo Petro deploys troops to the 2,000-kilometer border, calling it an assault on Latin American sovereignty. Cuba loses military advisors and denounces state terrorism. Russia and China object strenuously. Both have lent billions to Venezuela and import its oil. China purchases most Venezuelan crude, refining it through swap deals with Reliance Industries in India. Power shifts structurally, from state monopolies to potential joint ventures, from sovereign control to external influence. The global south watches closely. Another precedent in Latin America, another intervention justified on grounds of narco-terrorism and illegitimacy. If you value analysis that treats financial history seriously, subscribing simply ensures you don't miss work like this. Now the relevance sharpens. Prices are the headline. Plumbing is the story. Global equity markets shrugged off Venezuela. The S&P 500 closed 2025 at record highs, driven by AI gains and Federal Reserve rate cuts. The MSCI World Equity Gauge recorded 21% gains. Investors bet on continued momentum. But underneath, the system reveals fragility. Venezuela demonstrates rolling top logic. Markets don't peak with dramatic crashes. They peak gradually, flexibility disappearing without notice. Venezuela's GDP peaked in 2012. The collapse unfolded over 13 years. Each year looked survivable. The system adapted until it couldn't. Oil oversupply dominates 2026. OPEC Plus pauses, production increases. U.S. crude output hits record 13.8 million barrels per day. Prices languish near 6-month lows despite geopolitical tensions. Supply outweighs demand. Hidden forces stir beneath calm surfaces. The yield curve uninverted in 2024. Short-term rates dropped as the Federal Reserve cut rates. Long-term rates held steady. This pattern typically signals not recovery but credit stress. Banks' margins compress. Liquidity tightens. Inversions predict recessions. Uninversions predict strain masked by policy easing. Late-cycle psychology emerges. Complacency reigns when apparent stability persists. Professionals assume volatility has been tamed. Risk management becomes about positioning, not prediction. The question isn't whether disruption will occur. The question is whether systems maintain flexibility when disruption arrives. History doesn't repeat events, it repeats incentives. Nations chase resources while ignoring structural plumbing. Venezuela poured revenues into social programs while hollowing out PDVSA's technical capacity. The plumbing, the skilled workforce, the infrastructure, the institutional knowledge, decayed invisibly. Markets similarly focus on prices while ignoring plumbing. Repo market squeezes, liquidity backlogs, collateral shortages. These mechanisms operate beneath attention till suddenly they don't. Awareness trumps forecasting. You can't predict the timing of breaks. But you can recognize when systems trade flexibility for temporary stability. Venezuela traded diversification for oil dependency. That trade generated prosperity for decades, until conditions changed. The U.S. intervention reveals another layer. Energy sovereignty competes with efficiency. Rebuilding Venezuela's oil sector could eventually triple output to 3 million barrels daily. That bearish pressure on already oversupplied markets. Energy companies might benefit. Energy prices might not. Trade-offs compound. Position for contingencies, not certainties. Understand incentive structures. Recognize when success creates the conditions for later failure. Slow now. 2 takeaways anchor this. First, about systems. They endure until flexibility vanishes. Venezuela's petrostate thrived when oil prices stayed high. It had no mechanism to adjust when prices fell. The system couldn't bend. It broke. Financial systems operate similarly. Leverage works until conditions shift. Complexity generates efficiency until it generates fragility. Second, about human behavior. We optimize for short-term gains while deferring risks that compound. Venezuelan policymakers knew diversification mattered. They intended to build other sectors. But oil revenue was immediate. Diversification was future. The future never arrived. Markets display identical patterns. Extend duration when yields look attractive. Add leverage when volatility seems low. Defer the question of what happens when conditions reverse. Calm prevails now. Venezuela's collapse unfolded over 13 years. The intervention occurred in 30 minutes. The gap between those timescales tells the story. Fragility accumulates slowly. Breakpoints arrive suddenly. You can't predict them. You can recognize the structure underneath. If this helped you see the system more clearly, consider liking the video and subscribing. Not for predictions, but for perspective.